Today, we're going to go ahead and talk about Chapter 6, which is dealing with variable costing and segment reporting tools for management. So let me go ahead and take a look and share the screen with you. So again, one of the main things that we're going to be looking at this time is the two approaches that are used for valuing inventories and the cost of goods sold. One approach is called absorption costing, is generally used for external reporting purposes. The other approach, called variable costing, is preferred by some managers for internal decision making and must be used when an income statement is prepared in a contribution format. And so this chapter shows how these two methods differ from each other. It also explains how to create a segmented contribution format income statement. Three simplifying assumptions are going to be made in this chapter, and they are that normal costing rather than actual costing is used, meaning that the predetermined overhead rates are going to be used to apply overhead to the product. The other thing is that the actual number of units produced is used as the allocation base for assigning actual fixed amounts for overhead to products. The other thing is that variable manufacturing costs per unit and the total fixed manufacturing overhead costs per period will remain constant. So remember that variable costing treats only those costs of production that vary with output as product costs. So only the areas that would, the costs that would change with output would be considered part of our variable costs. This approach dovetails with the contribution approach, income statement, and supports our CVP analysis because of its emphasis on separating variable and fixed costs. So we see in this example here that our product costs, which would be our variable costs, are going to be things such as direct materials, direct labor, and then variable manufacturing overhead. And then our product costs then under variable costing are our fixed manufacturing overhead, variable selling and administrative, and fixed selling and administrative. And then we see there for absorption. Now, so for us, the costs of production, again, are direct materials, direct labor, and variable overhead. Now, for simplicity, nearly all the examples, exhibits, problems, and exercises in this chapter will treat direct labor as a variable cost. However, students should be reminded that labor is essentially a fixed cost in some companies. This is a growing phenomenon, as pointed out in earlier chapters. This, under a variable costing, direct labor should not be included in product costs as when it is a fixed cost. This point is reinforced in a discussion on theory of constraints at the end of the chapter. But just know that ordinarily it is a variable cost, direct labor, but remember that a lot of things now are being done via automated means, so they're not as labor intensive in the production side, but you still obviously have labor in other areas. So just being aware of that. And then fixed manufacturing overhead and both variable and fixed selling and administrative are treated as period costs and get deducted as from revenue as they're incurred. So our variable selling administrative, fixed variable, fixed selling administrative, those are period costs. Okay. And again, the only difference between variable and absorption costing is how the two methods treat fixed manufacturing overhead costs. And it also, under both methods, selling and administrative costs are period costs and are not product costs. And then Remember that under absorption costing, we're going to treat all costs of production as product costs, regardless of whether they are variable or fixed. Since no distinction is made between variable and fixed costs, absorption costing is not well suited for CVP computations. And then also the cost of a unit of production consists of direct materials, direct labor, and both variable and fixed overhead. And variable and fixed selling and administrative expenses are treated as period costs. And as we said, they're deducted from revenue as incurred. So let's do a couple of quick check questions. So first of all, which method will produce the highest values for work in progress and finished goods inventory? And the answer would be absorption costing. All right. So unit cost computation. So assume that Harvey Company produces a single product with the available information that we see. So they produce 25,000 units annually. They have direct materials, direct labor, and variable manufacturing overhead of $10. They have selling and administrative expenses of $3 a unit. They have fixed costs per year, manufacturing overhead of 150,000, selling and administrative expenses of 100,000. And the unit product cost under absorption and variable costing would be $16 and $10 respectively. So under absorption, it would be 16. Under variable costing, it would be 10. Remember that under the absorption costing, all production costs, variable and fixed, are included when determining unit product cost. Under variable costing, only the variable production costs are included in the product costs. And then remember that before beginning we're going to start looking at income comparisons. It's important that we remember the relationships between the ending inventory and the net operating income. Higher ending inventory results in higher net operating income since costs of goods available for sale less ending inventory equals cost of goods sold. Therefore, a higher ending inventory results in lower expense. So the cost of goods sold deducted to arrive at the net operating, because we have them available for sale, but we haven't sold them yet. So if we have more inventory, then we haven't sold it yet. So just be aware of that, how that would, the effect that would have. Okay, so now looking at some income comparisons. So let's assume that Harvey Company sold 20,000 units at a price during the year at a price of $30 each, and they had no beginning inventory. And so we'll go ahead and compute the net operating income using both absorption and variable costing. So this is under variable costing. So we said that each unit product cost is $10 because that's including only the variable manufacturing costs only. So the direct labor, direct materials, and then the variable was variable overhead. And then all 150,000 of the fixed manufacturing cost is expensed within that period. And then the net operating income would be $90,000 for that. Now, under absorption costing, we have the product cost is 16 because we're including all of the unit product cost in that. And then the fixed manufacturing overhead cost deferred in inventory is 30,000. That's 5,000 units times 6 per unit that they have, but that we haven't sold yet. And so the net operating income is 120,000. And where we got that deferred inventory is the fixed manufacturing overhead deferred in inventory is 5,000 units times 6 or 30,000. That's where they got that. Now, explain it under absorption costing, the recognition of fixed costs as an expense is really a timing issue. When the items are sold, the fixed costs will be reflected on the income statement as part of the cost of goods sold. So once they're sold, they will be reflected. Okay. So now comparing the two methods. Under absorption costing, 120,000 of fixed manufacturing overhead is included in cost of goods sold, and 30,000 is deferred in ending inventory as an asset on the balance sheet. Under variable costing, the entire 150,000 of fixed manufacturing overhead is treated as a period expense. The variable costing ending inventory is 30,000, less than absorption costing, thus explaining the difference in net operating income between the two methods. The difference in net operating income between the two methods, 30,000, can also be reconciled by multiplying the number of units in ending inventory, which is 5,000 units, by the fixed manufacturing overhead per unit, which is $6. That is deferred in ending inventory under absorption costing. And then extended comparisons of income data. So again, two other assumptions and facts about the Harvey company is they're going to have 30,000 units that they're going to be sold in year 2. That the selling price per unit, the variable costs per unit, and the total fixed cost and the number of products produced is going to remain unchanged. And 5,000 units are therefore in the beginning inventory in that second year. So again, some more information about the Harvey company that we see the way I just went over. So since the variable cost per unit, total fixed costs, and the number of units produced remained unchanged, the unit cost computations also remain unchanged. And then under variable costing, the unit product cost is $10. All 150,000 of fixed manufacturing overhead costs is expensed within the current period. And so the net operating income is going to be $260,000. And then under absorption costing, so the net product cost is $16,000. Excuse me. The unit product cost is $16. The fixed manufacturing overhead cost released from inventory is $30,000. Again, that's 5,000 units times $6 per unit. So that was what was left over that they're going to put toward the next period. And then the net operating income is going to be $230,000. So if we go ahead and we want to compare both methods, we see that the difference in net operating income between the two methods, which is the 30,000, can be reconciled by multiplying the number of units in beginning inventory, which is the 5,000 units, by the fixed manufacturing overhead per unit, which is $6. That is released from the beginning inventory under absorption costing. And then across the 2-year time frame, both methods will have reported the same total net operating income of $350,000. This is because over an extended period of time, sales cannot exceed production, nor can production much exceed sales. The shorter the time period, the more the net operating income figures will tend to differ. Okay, so summary of some key insights. When units produced equals units sold, the two methods report the same net operating income. When units produced are greater than units sold, as in year one for Harvey, absorption net operating income is greater than variable costing net income. It's because they had already produced the units, but they hadn't sold them in year one. Now, when units produced are less than what is sold, as in year two of Harvey, the absorption costing net operating income is less than the variable costing net income. And then some advantages of variable costing and the contribution approach. Enabling CVP analysis. Variable costing categorizes costs as fixed and variable, so it is much easier to use this income statement format for CVP analysis. And remember that absorption costing assigns per unit fixed manufacturing overhead costs to production. This can potentially produce positive net operating income even when the number of units sold is less than the break-even point. And that is because a portion of the fixed manufacturing overhead cost resides with inventory when units remain unsold. So that's how common absorption costing, even when they haven't reached the break-even point, they still could have positive operating income, just because of the timing of when things are being recorded. Okay. So explaining changes in net operating income. Variable costing net operating income is only affected by changes in unit sales. It is not affected by the number of units produced. As a general rule, when sales go up, net operating income goes up and vice versa. Absorption costing net operating income is influenced by changes in unit sales and units of production. Net operating income can be increased simply by producing more units, even if the units are not sold. So if we're doing this under absorption. So supporting how this supports decision making. Variable costing correctly identifies the additional variable cost incurred to make one more unit. It also emphasizes the impact of fixed cost on profits. Absorption costing gives the impression that fixed manufacturing overhead is variable with respect to the number of units produced, but it really isn't. This can lead to inappropriate pricing decisions and product discontinuation decisions. So you're better off to use variable costing because that's going to lead to more accurate decision making. And then we're going to look at using a segmented income statement and the contribution approach. So first of all, a segment is a part or activity of an organization about which managers would like cost, revenue, and profit data. Examples of segments might include divisions within a company, sales territories, individual stores, service centers, manufacturing plants, marketing departments, individual customers, and product lines. So all different ways that companies might want to segment out their company and their financial data. There are two keys to building segmented income statements. First, a contribution format should be used because it separates our fixed from variable costs and it enables the calculation of a contribution margin. The contribution margin is especially useful in the decisions involving temporary uses of capacity, such as special orders, to see if we should accept a special order or not, or what the impact of that would be. Second, traceable fixed costs should be separated from common fixed cost to enable the calculation of a segment margin. Further clarification of these terms is as follows. So what is a traceable fixed cost? Traceable fixed costs arise from a segment is a fixed cost that is incurred because of the existence of the segment. If the segment were eliminated, the fixed cost would disappear. Examples of traceable fixed costs might include the salary of a Frito product manager at PepsiCo was traceable fixed cost to the Frito business segment of PepsiCo. So if the Frito segment didn't exist, we wouldn't have a Frito product manager. The maintenance cost for the building in which the Boeing 747 are assembled is a traceable fixed cost to the 747 business segment of Boeing. So again, if they weren't producing those planes, we wouldn't need to worry about what the maintenance cost would be on that building, because we wouldn't have that building. A common fixed cost is a fixed cost that supports the operations of more than one segment, but is not traceable in whole or in part to any one segment. And so again, examples might be the salary for the CEO of General Motors would be a fixed cost of the various divisions of General Motors, because they don't, they have what General Motors has, maybe has a truck segment. They have a, pickup truck segment, an SUV segment, maybe a commercial segment, so on and so forth. But the CEO oversees all the segments, not just any one particular one. Another example might be the cost of heating of a Safeway or a Kroger grocery store would be a common fixed cost of the various departments. So the grocery department, the produce department, the bakery, the deli, so on and so forth. Because the reality is you're heating up the entire store, not just one particular area of that store. And it's important to realize that the traceable fixed cost of one segment could be common to another segment. For example, the landing fee paid to land an airplane at an airport would be traceable to a particular flight, but it's not traceable to first class, business class, or economy class passengers. It would just be for that entire flight. Now, in practice, there is great deal of disagreement exists about what costs are traceable and what costs are common. Some people claim that except for direct materials, virtually all costs are common fixed costs that cannot be traced to products. Others assert that all costs are traceable to products. There are no common fixed costs. The truth probably lies somewhere in the middle. Many costs can be traced to products, but not all costs. Okay, so a segment margin then is computed by subtracting the traceable fixed costs in a segment from its contribution margin. The segment margin is a valuable tool for assessing the long-term profitability of a segment. And in allocating common costs to segments reduces the value of the segment margin as a guide to long-run segment profitability. So we would not allocate common costs to the segments, only those that are traceable, in order to figure out the segment margin. Now, it's also important to note that a segment should not automatically be eliminated if its segment margin is negative. If a company that produces, for example, hairstyling products discontinues its styling gel, sales of its shampoo and conditioner might fall due to the unavailability of the eliminated product because the products would complement each other. So it wouldn't, so you want to make sure that you're not eliminating one product and then because of that, then causing problems then where people aren't going to want to buy your other products. You have to take everything as a whole. So let's look at an example of a segmented income statement. Assume that Weber Inc. has two divisions, a computer division and a television division. And we'll take a look at the contribution format income statement for the television division is shown here. And we notice that the cost of goods sold consists of our variable manufacturing costs, and that our fixed and variable costs are listed in separate sections, and that our contribution margin is computed by taking our sales minus variable costs, and that the divisional segment margin represents the television division's contribution to the overall company profits. Now, the television division's results can be rolled into Weber Inc.'s overall results as shown. Notice that the results of the television and computer divisions sum to the results shown for the whole company. Because again, they have their television division, their computer division. You add up both divisions together, you're going to get the amount then for the entire company. The common cost for the company as a whole of 25,000 is not allocated to the divisions. So we have 25,000 of it we're not able to divide to any particular division. Those are things that would be common to both divisions. Now, the television division's results can also be broken down into smaller segments. This enables us to see how traceable fixed cost to the television division can become common costs to smaller segments. Assume that the television division can be broken down into two major product lines, regular and big screen. Okay, so the television division's results can also be broken down into smaller segments. This enables us to see how traceable fixed costs of the television division can become common costs of the smaller segments. So again, we have two different product lines. So they have assumed that the television division broken down into regular and big screen. Assume that the segment margins for these two product lines are as shown. And then we can go ahead and add up everything to figure out then for the entire division. So of the 90,000 in fixed costs that were previously traceable to the television division, 80,000 of it are traceable to the two product lines. 10 is common to that division, but not to any one specific product line. Okay, so segmented income statement, decision-making, and break-even analysis. Now, to illustrate how the television division's results can be used for decision-making, assume Weber believes that if the television division spends $5,000 additional dollars in advertising, it can increase the sales of regular and big screen televisions by 5%. Weber can compute the profit impact of this course of action as follows. The regular product line contribution margin would increase by $5,250. The big screen product line would contribution margin would increase by $2,250, and the television division's segment margin would increase by $2,500. Computing company-wide and segment break-even points for a company with traceable fixed costs. So to demonstrate how to calculate company-wide and segmented break-even points, let's refer back to the company-wide income statement segmented into the television and the computer divisions. The countrywide or the company-wide break even point is computed by dividing the sum of the company's traceable fixed costs and common fixed costs by the company's overall contribution margin ratio. This equation can be used to compute Weber's company-wide break-even point of 361,111. So the break-even point is going to be the 170, which is the traceable fixed cost, plus 25,000, which are the common expenses, divided by the contribution margin, which is calculated to be 0.54. And you get the contribution margin by taking the amount 270, which is the contribution margin, dividing by sales, gets you 0.54. The overall for the company break-even point would be 361,111. Now, a business's segments break-even point is computed by dividing its traceable fixed costs by its contribution margin. And so you can do that then for each individual segment. And so we can do this for the television segment, and then we can also do this for the computer segment. So using this same equation, the break-even point for the television division is 180,000. So you take 90,000 divided by 0.5 is 180,000. And you get the 0.5 by taking the 150,000, which is the contribution margin, divided by the sales within that division. And then the same thing for the computer division. So 80,000 divided by 0.6 is 133,333. And we get the contribution margin to 0.6 by taking the contribution margin for computers, which is 120,000 divided by 200,000. Now, notice that the company-wide common fixed costs are excluded from the segment break-even calculations. So we do not include the costs that are common to all. This occurs because the common fixed costs are not traceable to segments and are not influenced by segment level decisions. So we're only looking at breaking it up by segment, we're only looking at what would go within that particular segment. So now notice that the company-wide common fixed costs are excluded from the segment break-even. This occurs because the common fixed costs are not traceable to a segment and are not influenced by segment level decisions. So we're not going to include that 25,000 in there. Okay, so segmented income statements, common mistakes, omission of costs. So the costs that are assigned to a segment should include all of the costs attributable to that segment from the company's entire value chain, as will be described in Chapter 12 when we get there. Now, since only manufacturing costs are included in product costs under absorption costing, those companies that choose to use the absorption costing for segment reporting purposes will omit from their profitability analysis all upstream and downstream costs. Upstream costs include research and development and product design costs. And downstream costs include marketing, distribution, and customer service costs. Although these upstream and downstream costs are non-manufacturing costs, they are just as essential to determining product profitability as are manufacturing costs. Omitting them from profitability analysis will result in the undercosting of products. And an example of a company that would have very high amount of both upstream and downstream costs would be a pharmaceutical company such as Merck. A great deal of its costs are comprised of the research and development and its marketing, right? If you think about, for example, a lot of the pharmaceutical companies, obviously to develop the drugs cost quite a lot to be able to do that, all the different medications and that, to develop all of that. In fact, it's even possible to even work to develop something and then not have it not even turn out to be something that they could even sell, either because it's unsafe or it's not effective, or they just simply decide to not bring it to market. It's not worth it to bring it to market. So there is that is an area that you have to consider. Another area to consider is that, and of course, you have all of the marketing costs and all of that as well that come after, and again, with a pharmaceutical company, we see that with all of the TV ads. I know now anytime I scroll Facebook, I keep getting Facebook ads for different medications and stuff and this and that. So it's for conditions I've never even heard tell of. So there's a lot of that. So the nose costs, of course, are not included in this when we look at it by each segment. Okay, inappropriate methods for assigning traceable costs to segments, and then also the failure to trace costs directly. So again, costs that can be traced directly to specific segments of a company should not be allocated to other segments. Rather, such costs should be charged directly to the responsible segment. So, for example, the rent of a branch office of an insurance company should be charged directly against the branch office rather than included in the company-wide overhead pool and then spread throughout the company, because it's affecting something that affects that particular branch. Another area to be aware of is having an inappropriate allocation base. And so some companies will allocate costs to segments using arbitrary bases. Costs should be allocated to segments for internal decision-making purposes only, when the allocation base is actually what drives the cost being allocated. So, for example, sales are frequently used to allocate selling and administrative expenses to segments. This should only be done if sales drive those expenses. And then arbitrarily dividing common costs among segments. Common costs should not be arbitrarily allocated to segments based on the rationale that someone has to cover the common costs for two reasons. The first reason being is that this practice may make a profitable business segment appear to be unprofitable. If the segment is eliminated, the revenue lost may exceed the real traceable costs that are avoided. Second, allocating common fixed costs forces managers to be held accountable for the costs that they cannot control. So now we'll look at some fixed costs, and then we'll look at the appendix. So quick check 2. So we have an income statement for the Hoggus Land, Lakeshore, the bar, and the restaurant. And we assume that they prepared their segmented income statement as shown. So how much of the common fixed cost of $200,000 can be avoided by eliminating the bar? So they have a common expense of $200,000. And how much of that could be eliminated by just simply eliminating the bar? And the answer would be none of it. Common fixed costs cannot be eliminated by dropping one of the segments, because again, you're going to have it. If it's common, you're going to have that regardless. Now, suppose that square feet is used as the basis of for allocating the common fixed expense of $200,000. How much would be allocated to the bar if the bar occupies 1,000 square feet and a restaurant 9,000 square feet? And the answer to that would be 20,000, because the bar would be allocated 1/10 of the cost or 20,000. So if it was something that could be attributable to the square footage, the bar only uses 1,000 square feet, whereas the restaurant occupies the rest. So you can allocate it that way if it is something that truly is associated with that. Now, if Hoggus Lands allocates its common fixed cost to the bar and the restaurant, what would be the reported profit for each segment? And so again, if we're doing that based on the square footage, we see then that the bar actually would lose 6,000 and a restaurant would have a profit, a net operating income of 50,000. So then do you think that the bar should be eliminated based on this information? What do you think? So should the bar be eliminated? The answer is no. Remember that the profit was 44,000 before eliminating the bar. If we eliminate the bar, the profit would drop to 30,000. So even though it would appear that by dropping the bar, they would actually be doing better, the bar is what helps to bring people in to the restaurant. So just being aware of that. So you don't want to drop the bar because then it would affect the entire thing. So it's why you have to be very careful about how you are allocating common costs and exactly, what it is and how you're looking at the situation to make sure that you're understanding what actually is taking place.